All right, everybody. I'm here with Andrew McCready. We
Hey
are going
everybody.
to do the post Mogul Mastermind Q&A for his awesome presentation. First thing I'd like to say is, Andrew, thank you again for coming and giving such a dynamic and interesting presentation. It can be a dry topic, but you definitely made it interesting for everybody. So thanks for taking the time to come out.
Thanks for having me.
Yeah, it was our pleasure. Now, some of the follow-up questions that I got were, first, let's talk about the specifics. And one of the questions I got were on the specifics of getting an account set up with a company like Olympia Trust. So the first question I got was, how big is the application? Like, how many pages of paperwork does a person have to fill out?
So I believe it's 40 to 60 pages, but only about 3 to 4 of those pages have anything to fill out.
Got
So
it.
you can pages and pages of fine print that realistically most people aren't reading. Much like with a lot of bank documents. Most of it's pretty basic. Like when I'm asking people for information so that I can open accounts, because keep in mind, I can open on their behalf. Like obviously the client will need to sign, but usually the process would be I'd ask somebody for a list of information. They give it to me. I pre-populate all the paperwork,
Right.
and then mark where it needs signatures. So I believe, you'd be talking about 5 or 6 signatures that you'd need to open an account. And I would need to ask for, name, birthday, SIN number, address, just the basics. That's all I'm asking for is the basics. And then of course, the amounts that we're talking about, if there's a transfer, what institution it's coming from. Usually somebody would just give me an account statement for a transfer. And then I attach the account statement. And then of course that has the bank address and whatever else included.
Got it. Okay. Now, once all that's filled out and you submit it to Olympia Trust, do you have to reach out to your current bank and tell them to move the money over to Olympia? Does Olympia reach out to them? Like, what do you do?
Olympia manages the process. So you give instructions, Olympia executes the instructions. And of course, I'm using Olympia as a proxy here. There are other
there's others, yeah.
Yeah, exactly. So you give Olympia instructions that apply to your other bank. Olympia manages everything from that point. It's possible that there can be hiccups, like your bank could call you and confirm, but you will not need to manage the process. You're not going to need to give instructions beyond, I'll sit down with people one time and everything, and then once it's all signed, that's the last instruction you should have to give. One out of 50 deals, they're going to say, oh, well, it doesn't look like the signature matches, or we need to call our client to confirm that's what they want to do. But most of the time, it's a pretty seamless process. And most of it happens behind the scenes, and you just have to kind of set it up the way you want in the beginning, and then all the wheels turn in the background.
Got it. Okay. And then how long does it take from the time you open the account at Olympia or wherever else, from the time that you give them the instruction to the time the money actually can get transferred over? What's the average wait time on that?
A transfer takes anywhere from about 3 weeks to a month.
Wow.
Contribution will take about 2 days.
You said contribution 2 days. Okay.
Yeah. So if you wanted to open an account, we could have it open, by end of day tomorrow kind of thing, and clear a check and the money's in. But if you want to transfer it, it's going to take about a month.
Right.
Now, I mean, different investments, like my investment has a closing at the end of every month. So, there is a chance that you could have some kind of idle time, like where the money transfers in on the 14th and then it doesn't actually enter until the end of the month. But for the most part, that's pretty minor. What you want to avoid is having your money sit in limbo for significant amounts of time, months.
Okay. All right. So procedurally, it sounds like it's a little bit time consuming, but it's not overly complex.
Yeah, and the time-consuming part happens behind the scenes. So you sit down, have a single meeting. At the end of that meeting, the wheels are in motion, and then although it does take some time, you don't really need to kind of worry about it during that time.
Got it.
It's sort of like somebody signs a deal for real estate with you. It can take a month or so to close, but you really only need to worry about it through the process, and the process just has a gap in it.
Got it.
Similarly.
Makes sense to me. Okay. let's switch gears because we did get quite a few questions about the idea of lending RRSP funds to create like a mortgage to buy real estate with.
Yep.
So the first question that we got was just a clarification. So can you actually lend money to yourself from your own RRSP as like a mortgage?
Yes. Now, I mean, so it's what's called a non-arm's length mortgage.
Sure.
So now, in order to do that, you have to have a trustee in place.
Right.
So there has to be an institution that has agreed to, basically manage that process. The only one that I could find in my fairly quick search, because I know there was institutions that used to offer this that seem to not anymore, was Canadian Western Bank Trust. So still, a large reputable institution. There aren't, like, some people use this and look for kind of, loopholes. Oh, well, what if I just loan money to myself out of my RSP, then never pay it back, and I keep the property? Haha. Well, you can't. There are no loopholes. Having a trustee in play means the trustee is going to act like a bank. They're going to act on behalf of the RRSP account and not you, a person. So that means if you were to, if you agree to a payment schedule and miss any payments, they're going to act exactly the way that a bank would. Even though the money is going from you to you, you still need to treat it like a regular mortgage. You still need to qualify like a regular mortgage, which is why I made those points in the presentation, that it will usually never make sense to do this for just a regular mortgage on a house that you live in. If you're for investment, you get the benefit of effectively lowering your rate of return on the property, which is taxable, while getting to write off money going into your RRSP. Yeah, exactly.
Yeah,
but if you're not doing that, I mean, you should basically just forget about it unless it's being used.
Right, so it should be specifically for investment purposes.
Yeah.
Got it. And can you talk a little bit about the paperwork to make that happen? And, I actually going to ask two questions at once. Let's stay with the paperwork first. So talk about the paperwork to make that happen.
I'm not going to lie. I know about the process. I haven't done one of these personally. Like I haven't given myself an RSP mortgage. So I only know about this conceptually. You would, like, in many of these cases, like, I open accounts for Olympia Trust all the time, computer share. We deal with other institutions where I can kind of get the ball rolling on their behalf. There were a lot of products I talked about that I don't sell. So I can't technically, I know about them. I know how mortgage investment corporations work. My company doesn't offer any. So I can't actually walk someone all the way through. If somebody wants to just chat with me about it, anything that I know anything about, I'm happy to chat about.
Right.
But in this instance, you would have to talk to the institution that we're talking about. So either for an arm's length, there was a whole list there in the slides, Olympia Trust and Canadian Western Bank Trust and B2B Bank and computer share. And for an arm's length, I think just basically Canadian Western Bank Trust.
Got it.
So if you contact them, they should be able to walk you through the paperwork.
Okay. So they'll walk you through the paperwork, and then, it's just like anything else. It has to get closed through a lawyer, right?
Yeah.
Okay. I'm going to switch gears again, because I think one of the confusions that people had is the fund that you represent, it's similar to a mortgage investment corporation, but it's also a little bit different. So can you explain what the difference between your fund and the mortgage investment corporation is and how they differ?
Okay, so how they're the same is that in both cases you have a pool of capital.
Yeah.
Your money joins the pool, and then every dollar in that pool behaves the same way. So it's, all of the wins and losses are shared. So basically everybody collects their money and then distributes it out in the form of loans. Then the interest from those loans is paid out in full to investors. Now, where they differ is what the loans are and what the basis and security of the loans are. So a mortgage investment corporation, as the name suggests, they hold nothing but mortgages, and it's a fairly straightforward model. You're usually looking at the position of the mortgage, and then you're looking at the loan to value ratio averages and whatnot, so, and whatever other metrics that you could look at.
Right.
In our case, we're loaning to companies. There is sometimes real estate collateral and real estate security, but the metrics are different. So, again, you've got this pool of capital. It's being loaned out in the form of secured debt. but secured debt to a company, not on a land title. So, if we're talking about, let's say, a bunch of companies where they've all been in business for 20, 30, 40, 50 years, they've got a good, stable business model, a healthy balance sheet. We would often look at what's called the debt service coverage ratio. So again, it's about, trying to find metrics that show how safe the investment you've made, the loan that you've issued, how safe that loan is.
Yeah.
Now, if you're talking primarily about a company or cash flow, like let's say a cleaning company, we've got one that we're closing on this week. It's a tremendously safe business model. They've been in business for 30 years. They've had many of their clients for 27 years.
Mm-hmm.
They've never lost a service location. It's a nearly recession-proof business, but there are no real tangible assets. What you're loaning on is the cash flow. Now they have a amazingly stable cash flow, but we can't say that there's a loan to value in that sense. We would say, what is the ratio of the loan we're making to the cash flow? So a debt service coverage ratio. So it works like a loan to value in the sense that it's like, how much breathing room do you have in the deal? And then you can look at averages again. So in our portfolio, the minimum, like the gate to get in is 20% breathing room, but the average is like 36, 37%.
Okay, that makes sense. Okay, no, that really resonates, and I thanks for explaining that, because I think I know you explained it in your presentation, but with complex ideas, it's often nice to get a second
I
go
covered a
around
lot in the presentation, absolutely.
You really did, yeah. Your presentation was awesome. I mean, I couldn't believe how much factual information you were able to get through in such a short period of time. So that's why I'm just trying to unpack it a little bit for everybody who didn't quite catch it the first time. But yeah, no, that was awesome. So I guess the next question that came up quite a bit is, and I know you covered this in your presentation, but everybody, they see double-digit returns. It's exciting. I mean, that's the cool thing about the different options that are available in this, in this kind of self-directed space, is that the returns that a lot of these companies do are technically, historically, quite a bit better than what an RRSP would do.
Mm-hmm.
But everybody understands that risk and reward have to happen in balance. So what risks would you say people are taking on to access the benefit of that additional reward?
So, I mean, I guess I could answer in a general sense and then specific to my company. I mean, you're absolutely right. Never be too dazzled by a high return. There's almost inevitably high risk that goes along with it.
Right.
In our specific example, there's effectively only one risk. The risk is that we loan money out and it doesn't come home again.
Yeah.
So, I mean, there's really nothing else that can go wrong, but that's a pretty big one.
Yeah. I mean, people
now, the same risk applies to mortgage investment corporations.
Mm-hmm.
What was that, sorry?
I was just building on your point and agreeing with you. Sorry, keep going.
Okay, sorry. I think I had a little snag on the connection there.
No problem.
So yes, I mean, there are always risks. This is where the homework part comes in. I mean, you want to look at the history, like, there are funds like, to use an example that I'm less biased on, Fisgard Capital was referenced in my presentation. I mean, they've been around for decades, and, I don't think that they've ever had a year where they didn't pay a good, healthy, solid return.
Mm-hmm.
So there are certainly investments that have for a very long time delivered above average, higher than market yields. And sometimes they're just kind of flying under the radar because they're not publicly traded. They're not necessarily, in our case, we're not raising the amount of capital that would get us out in the front page of the newspaper. Like, when we bring in money, we have to then spend it. And if we aren't able to loan it out and generate the yield, then we can't accept it. So, given that we've got about $300 million assets under management, we're not a small company, but in the world of private equity, we are relatively small.
Right.
And in the world of the public markets, $300 million is nothing. And, given that we're raising, I don't know, 8 figures a year, it's not nothing, but again, in the public market space, it's not that big.
Right.
So it's easy for an investment like that to kind of get a little bit overlooked. Back to that risk thing. you know, again, there are certainly exceptions to the rule, and this is where, you know, doing a lot of homework comes in. You want to try
Yeah.
to put in the time and effort to try to find out who is consistently delivering. I mean, our company, we've got a 3-year track record. In those 3 years, we hit, you know, target 11% year 1, year 2, year 3. And then for 10 years before that 3-year period, we didn't have our fund in operation, but we were using the same financial model
Mm-hmm.
on a one-off basis. So basically doing exactly what we're doing now, except instead of it being pooled, it
Right.
was, you know, one-offs. Now, all of those debts performed. So basically we've got 13 years without a single debt going bad. You know, again, there are other funds. You know, I don't want to sit here and just kind of cheerlead for my own product. There are other funds that have very consistently delivered above market returns. And, you know, it's great to go in with your eyes open and do your research, but you want to find those, you know, kind of consistently delivering products.
Of
I
course.
mean,
Yeah.
or maybe you're a huge risk taker. You can find the ones that are inconsistent and can have a huge return. I'm not here to tell anybody what to do.
Yeah. That's awesome. All right. Well, Andrew, I think those were the main questions that came up from your presentation. We've got your contact information linked. We've got your slides and your presentation linked for anybody that wants to review it. Again, really appreciate you being a part of the event and just sharing your specific and professional expertise on the RRSP space. That was awesome, and thanks again.
Well, very happy to do it. And I would just say, you know, given that I did cover a lot of information and there's a lot of technical complexity, you know, don't hesitate to reach out. If somebody wants to chat about any of these things, whether it's something that I do specifically professionally or it's just something that I might know about,
Yeah.
happy to chat with anybody.
Well, you're generous with your time, Andrew, and that's why you're one of the best in the business. So thank you for making that offer to everybody, and thanks again for coming out. We'll look forward to having you speak again next time.
Okay, perfect. Have a great day.